When we're first starting out in investing, one of the things that we need to have an understanding of and make a decision regarding is what we call risk and reward. And these topics or concepts really are fundamental to investing. And in this video, we're going to explore the idea of risk versus reward in the context of investing. And then we're going to talk about some of the different risk factors with regards to investing, whether that is in something more liquid like a savings account or a certificate of deposit, to something that is maybe a little bit more risky but might have a higher upside or reward in the form of some sort of common stock or investing in a business and those sorts of things. So for starters, let's look at risk and reward. So the first thing I want to make very clear is there is a very linear relationship between risk and reward. So if we were to look at this, we could say that risk is on this axis here, and we have reward on this axis here. And as the potential reward, or you can also say return, which is the, let's say, percentage yield of a particular activity or investment increases, so does our actual risk. And so when we're evaluating investments, it's not a matter of simply evaluating them based upon the reward or the potential yield, but we also have to factor in the risk, because investing in stocks, while it might have a higher return, and so on paper you might say this is a better investment, we also have to consider the risk that we are incurring, which in this case represents the potential that our investment could actually decline in value or even be completely zero. So we might lose all of our investment. So every single investment has a different degree of risk, but the reward is somewhat related to that. When we invest, we deserve to be compensated for the risk that we incur. And so every single type of investment will have a different level of risk and subsequently a different reward attached to it. So let's look at an example. Let's say that we are going to invest in a certificate of deposit. And certificate of deposits, as you probably know, are considered to be short-term investments, fairly liquid. And what you do if you're not familiar is you agree to place a certain amount of money in an account with a bank of some kind for a certain period of time. So let's say anywhere as little as around 90 days to potentially up to 5 years. And you're compensated based upon the length of time that you have that investment kind of in the bank's possession. Now, it's fairly liquid because you could, if you needed the money, actually take the money out. So let's look at, but although you will have a penalty, I might want to add that there is a penalty for breaking the CD terms. So let's say we have a certificate of deposit here, and we're going to invest $1,000. And just to keep things fairly simple, let's assume this is a 12-month or 1-year CD, and the interest rate of this CD is 2%, which is probably much better than interest rates are currently, simply because of the fact that the Federal Reserve is intentionally keeping interest rates low as a way to encourage economic activity. But for the sake of this example, let's say 1% or 2% for our $1,000. In the year period, our investment would actually give us $20. Now, you might be thinking, that doesn't really sound like a great investment. And it is fairly low when we think about risk versus reward, but we have to think about the risk inherent in certificates of deposit. So with a CD is commonly FDIC insured. And assuming that yours is insured with the Federal Deposit Insurance Corporation, they're going to guarantee the investment up to $250,000, which means in the event that the bank becomes insolvent and is unable to actually have the cash to pay back those that have deposits with it, the FDIC is going to swoop in and is going to guarantee the deposits up to that amount. And every commercial bank pays for basically deposit insurance, if you will, which means they're paying a premium so that the FDIC has funds available to do this sort of thing. So from a risk standpoint, your risk is relatively low, which is why the reward isn't as significant. Okay. And that's the thing that you want to get with investments is if you're not willing to take risk, you're not going to be rewarded for that risk. And so when we talk about investing for a long-term period of time, like retirement, it's okay to take a little bit of risk. And in fact, you need to be able to incur a little bit of risk if you're going to be able to grow a investment so that it's going to be enough for you to draw on later on when you get close to retirement. If we're not really willing to take on that risk, then unfortunately our money isn't going to grow as significantly. We could be into issues later on. With that being said, if we have a really long time horizon, we're not necessarily concerned about the day-to-day of what the stock market is doing because we have a lot of time to make up those losses if we do incur them. Now let's look at a different example, and let's look at a bond. And a bond is simply an IOU. It's typically for government debt or corporations. So they talk about government bonds and corporate bonds. And bonds are a little bit more risky, right? So a bond in this case might have a value of $1,000, but let's say it gives us a 5% rate of return or the 5% reward, right? So over a year period, instead of getting the $20, right, we're now getting $50. But because the bond is a company bond or a government bond, there is a higher degree of risk there, particularly if it's a corporate bond, because there's a potential that the company might not be able to operate right. And that's what goes back to the importance of doing fundamental analysis, where we're looking at the financials of the business so that we can make a determination as to whether or not they are likely to continue to do well and be able to actually pay me back for not only my coupon payments, which represent this $50, but also for the par value that I'm supposed to get back after a certain period of time. In this case, let's say it's a year. So from the risk standpoint, we might be incurring a little bit more risk. And so for a bond, we might be over here because we are, again, incurring greater risk. And so based upon investments, we deserve to be compensated for said risk. Now, another example might be a business. And a business can be an investment also, particularly if you're willing to start your own, or if you're going to invest in someone else's business, maybe a friend or anyone else. And so your business investment, let's say, is still going to be $1,000, just to keep things simple. But the risk here is much greater, right? And if you were, and this is where negotiating comes into play, because if you were making an investment, you're trying to gauge, well, what's the likelihood of this business being successful and getting to the point to where I can recover not only what I invested, but also make a little bit of money. And so your risk is going to be probably much higher. Obviously, it's specific to the business, the industry, the market, all those different things, who's running it, track records. And so this is a very individual decision, but generally speaking, this is going to be much higher. And so you might want, let's say, a 20% return, or even higher for that matter, right? And a lot of times, especially when we talk about venture capital money and angel investments, they're talking about multiples, right? So you're not necessarily talking about 20%, you're talking about 200 to 500%, so 2x to 5x, maybe even 10, in order to make the investment worth it for you, because you're incurring a lot of risk, right? And so there's a chance that you might not make anything, and then this $1,000 or greater is gone. And so we want to be compensated for the risk. So the things that we need to be considerate of are if an investment promises a very significant return or reward, let's say, and is touted as being relatively risk-free, that is not the case. Because in order to provide that return, right, they're doing that in order to, of course, entice people to take the investment because it is relatively risky. Now, that doesn't mean that you shouldn't go through with the investment, but it's important to understand what you're getting into and if you're comfortable incorporating that kind of risk. Now, when we look at investments, we're typically thinking about a couple of different risk factors. Now, these are things that make an investment riskier. And so there are 4 that we're going to talk through. The first one is what we call inflation risk or inflationary risk. Now, inflation risk, how this works is inflation, as you probably know from going through econ, inflation is the increasing price of goods and services, right? And so inflation The Federal Reserve would like it to run about 1 to 2% a year. You've probably seen in the news the Federal Reserve is willing to allow inflation to grow even higher in an attempt to continue to kind of stimulate the economy and keep interest rates low. But inflation, of course, on the surface is actually okay because we want things to be going up in price because that means that people are making more money and their purchasing power is increasing. But we certainly don't want inflation to go up too much, right? Because that's when we get into issues. So for the sake of this example, let's use the CD that we just talked about. So the certificate deposit example where we have the $1,000 at 2% earning $20 per year. Let's say that inflation is actually running at 3%. What that means is that the price of goods and services, so anything you pay for from bread and eggs and milk at the grocery store to your insurance and everything in between, goes up, right? And so we do this thing called the CPI, which is the Consumer Price Index, which is a survey of a basket of goods that people purchase. And we do this every month to try to measure what inflation is. And so let's say based upon this measurement, it is growing by 3% on an annual basis. Well, this means this inflation risk, look at my certificate of deposit here, I'm getting 2%, which means I'm earning $20, but I'm paying $30, not 30%, $30 is my inflation risk. So I'm actually in a worse off position technically because the investment that I have isn't actually counteracting the effect of inflation. And so a lot of the inflation risk is the potential that the interest that you gain from a particular investment doesn't exceed the increased price of goods and services. And this is particularly problematic for very risk-free investments. So think like your savings account, your certificate of deposit, and those sorts of things. You're likely to incur some inflation risk. Now, with that being said, if the purpose of money in a CD, let's say, or savings account is for it to be liquid, then you might say, well, I'm okay incurring the inflation risk because I want this money to be readily accessible. And then I can use it, whether it's for an emergency fund or whatever the case may be. And that's a risk that I'm willing to incur. And ultimately, it's not that big of a deal. At least you might not think it is. Now, the next form of risk that we are going to talk about is what we call interest rate risk. And interest rate risk actually occurs when we are, let's say, locked into a particular investment and the interest rates are actually fluctuating. So typically interest rate risk is usually more cognizant with long-term investments. When our investments are more long-term, we incur greater interest rate risk because we're locked in. So let's use our bond example to go ahead and walk through just the impact of interest rate risk. And so let's say that our bond, again, we're investing $1,000 at a 5% annual interest rate or coupon rate, you could say, if you're going to use similar terminology. So we're going to get $50, and let's say we're locked in for 2 years. And what's the potential within that 2-year period that interest rates or the interest rate that's paid on bonds actually goes up? This is our interest rate risk. Now, if you're at 2 years, your interest rate risk isn't very significant, right? Because in 2 years, I get my money and then I can make a decision as to whether or not to invest again. But if we're purchasing a 30-year bond, we have a lot of interest rate risk because what the market looks like today might look really, really different in 30 years. Likewise, if we're in a relatively solid interest rate environment that's paying very, very high rates, let's say this interest rate is more like 10% is our reward, and we're only going to get, let's say, a 1-year bond, then we're also incurring interest rate risk because within that year period, the interest rate might actually decline as our bond is due, and now we're trying to roll that money over and we're getting much less. So in this case, right, maybe a longer term would make more sense. So the interest rate risk is always the potential that there's a change in interest rates in the economy, and that, of course, makes our investment value decline or has an impact on our investment. Now, the next one we're going to talk about is what we call business failure risk. And business failure risk is only, let's say, relevant when we're investing in a business, but it doesn't necessarily mean that we're funding a business, because this can be present in purchasing common stock, purchasing preferred stock, or even bonds within a company. So there's a potential that the business could fail, right? And this is what I mentioned earlier in the video. It's important for us to evaluate the fundamentals of the business, right? And to make sure that they're in a good cash position, that they have products and reliable revenue streams and opportunities to expand and those sorts of things, because that means that the business risk is smaller, let's say. So we don't maybe get as much compensation as a result of that because it's fairly stable. But if the business failure risk is higher, then again, that reward is likely to be higher as well. All right, the last one is market risk. And market risk is really tough to evaluate because, frankly, markets do all sorts of things and respond to all sorts of factors, whether it's economic news, whether it is government actions, whether it is a tweet that goes out, something that happens overseas, earnings reports from corporations. I mean, really anything, what Congress is doing. So the market risk is always very, very prevalent. When we think about market risk, what we're trying to think about here is the impact of the economy and ultimately how that might influence markets. And that's what's really tough about investing, is you could really do a great job of looking at the fundamentals of the business or looking at the track record of the mutual fund or the ETF or whatever security that you're looking at, and there are always market risks. So in kind of more turbulent times, right, there's a greater market risk. There's chances for more fluctuations, right? You could argue, at least in the US, with the coronavirus and how that is continuing to kind of persist. And you've got some states that are sort of locking down and others that are opening up. You've got a presidential election. All of those things represent market risk because there's uncertainty, and markets do not like uncertainty. So also one thing to consider is, again, the impact of the markets. But as we close up this lecture, again, what I want to really emphasize is this idea of risk and return, or risk and reward. And that is that as our risk or potential for losses increases, right, so does the reward as a way to compensate and actually incentivize us to incur that risk. But if we're not willing to take risk, there's not going to be a great of reward, which we might run into challenges if we're trying to invest for a longer period of time and grow, whether it's for retirement or some other large sum of money.